Swayam Prabha. Digital India. Educated India.
I extend my warm greetings to all of you. Once again, I would like to welcome you in this lecture series of Law of Banking and Negotiable Instruments. Hello, I am Dr. Raju Majhi, Assistant Professor, Banaras Hindu University, Varanasi. Dear students, as we have already discussed the many things about the banking law, but as far as concerned, the one very specific things which we have to discuss, and I have taken the two lectures in this series, the lecture 15 and the lecture 16. So, I am here to discuss with you the lecture 15. Lecture 15 is based on the two very important aspects. The one that is the loans and advances which is granted by the banker. Dear students, we know that it is one of the primary functions of the banking sector. So, to understand that when one of the primary functions which is given to the banking sector to grant loan and advances, because if you recall the definitions which you have read under section 5 clause B of the Banking Regulations Act, which define the term banking. So, very clearly mentioned under that the banker's primary business is to receive deposits from the public. And when he is receiving that deposit, his primary functions of banking, we can say, to lend or to invest that money. Unless and until banking is engaging himself in that business, or you can say in that functions, we cannot say that it's a banker. So, for that purpose, it is very important that the banker is liable to do that, and there is only source which is available with the banker that he has to lend or he has to invest, because that is his primary business, and through that he is getting all sorts of, you can say that his business, his the earning resource is the sole resource, you can say, that is investment of that money and lending that money, and to earn its own, you can say, the assets and the everything that is depend on the granting loans and advances. Now, at the same time, I proceed further. Just one thing I would like to recall you here, that it is not his money. As we know, the banker doesn't have its money. The banker is exercising, or you can, the money which is processed by the banking sector, that is comes through the deposit, and the deposit means it is the public money. So, when we are talking about the public money, as we have already discussed, it is one of the primary liability, you can say, or you can say the sole liability towards the depositors, that the banker has to return that money. And how it can be returned unless and until the banker have that money. So, the banker is making a very, you can say, the cordial, or you can say the very good relationship as far as concerned, that to earn and to return money to its depositors, those money he is investing or he is lending. So, to secure that loans and advances, we will have to discuss under this chapter the 2-3 things which is very important. In the entire lecture, I will discuss all those things. That the first thing I will discuss, that what are the very important thing, that is the principles of sound lending. That is one of the very important aspects of this lecture, that we will have to see that when we are talking about that the banker has that right, or you can say that when he is exercising that right, because it is the sole sources, or you can the sole the means through which the banker will earn money, and he will manage all affairs whatever he is necessary to obtain, or you can say to generate the fund. This is the sole. So, naturally the bankers, when he is advancing or granting a loans to the people, he has to apply some sort of the principles, and the principles are entirely based on that for the security purpose. So,
the principles of sound lending which I have taken the 5 points that has to be taken into consideration whenever the banking is granting the advance and loan. Dear students, these 5 principles are very important. Before granting the loan or advances by the banker to any persons, he has to ensure that 5 principles. The one is safety, the second one is liquidity, the third one is profitability, the fourth one is purpose of the loan, and the fifth one is the principles of diversification of risks. Again I am repeating it. These are very, you can say, the important, the principles. Banking, when he granting or lending someone money, he has to keep in mind that he has to follow that principles, and failing which the bankers may lead towards the loss, and he is going to create, you can say, the burden towards itself, because he is some time when will come, the bankers will find himself very uncomfortable positions, or you can say the bankers is not in a position to return the public money. So that's why whenever he is granting the loans and advances, he has to follow these 5 principles, that are cardinal principles we can say, as far as concerned the sound lending, that is safety, liquidity, profitability, the purpose of the loan, and the principle of diversification. We will discuss one by one. Dear students, for any purpose, that whenever any work which we are doing, at that time you are keeping that the safety is a very important aspect of it. So, as far as concerned the loans and advances, when the bankers is granting or he is extending to someone or he is providing to someone, he is also, he has to do or he has to keep in mind that is the safety, that is the first one. As the bank lends the funds entrusted to it by the depositors, the first and foremost principles of lending is to ensure the safety of the funds lent. By safety it means that the borrower is in a position to repay the loan along with interest according to the terms of the loan contract. As you know that dear students, that whenever the banker and the persons who is willing to borrow money from the bank, they will enter into an agreement. So, he will lend money or he will grant advances on the basis of that agreement. So, when he is entering into that agreement, he has to ensure that by going through the status of that the persons, means the borrowers or the banker to whom he is going to advance the money, he has to ensure that he has a capacity to return it. That is the safety when we are talking about, that he has to ensure by taking all sorts of, you can say, the precautions, and when the bankers will ensure that the persons is in a position, the persons who is willing to take money from the bank, he is in a position to return that money. So, naturally he has to check the utmost, you can say, the what are the resources, how it can be ensured that the persons who is taking money from the banker, after that the completion of that agreement, he is in a position to return the interest as well as the principal's money which he has taken from the bank. That is the first and foremost thing that has to be considered by the banking sector when he is granting a loan or advances to anyone. Now, the second one is very important as far as concerned, that as I have told you, that the principles as far as the sound lending, that is the liquidity. As you know that the banks are essentially intermediaries in short term funds, therefore, they lend funds for short periods and mainly for working the capital purposes. The loans are therefore largely payable on demand. The banker must ensure that the borrowers is able to repay the loan on demand or within a short period. This depends upon the nature of assets owned by the borrower placed to the banker. So, as you have already experienced earlier when we have discussed the relationship between the banker and customers, at that time we have seen as far as concerned the banker's rights. When we have discussed the banker's rights, the bankers got the rights of general lien. As a general lien, when will take anything in terms of the guarantee or the surety from the customer, he has a right that for the to possess that property with him, to retain that property, because he got that rights as a general lien rights. But as concerned, when we are talking of the general lien rights, we know that that cannot be sell out by the bailor in that cases. But as far as concerned that the customers and the bankers, when they are entering into that kind of relationship, then as I have told you, the another relationship which develop, that is a pawner and pawnee, and that becomes the pledge, and the pledge can be sold out to get back money. And for that purpose, it's very important that the things which he has taken, the payment can be made out from that has to be taken in form of the liquidity. The third, the sound principles as far as concerned the loan or advances, that is profitability. As you know, the bankers is not a charity. The bankers is also doing the business, and the business terms when we come, that means the person is concerned about to generate profit, and the bankers, because the bankers is mainly what kind of the services can be done by the banker, it is already prescribed under section 6 of the negotiable under the Banking Regulations Act, because beyond that he cannot do, because the section 8 of the Banking Regulations Act 1949, which prohibiting that the bankers cannot engage himself in any other business apart from or the besides which are described under section 6 subsection 1 of the Banking Regulations Act. So, the profit is very important. So, whenever he is lending, he must ensure that the relationship which is going to develop with the persons to whom he is going to give the loans or advances, whether it is profitable or not, that has to be taken into consideration. As the commercial banks are profit earning institutions, we know that. The nationalized banks are no exception to this. Even the nationalized banks, they are also involved in that. The only that in case of what they are doing, as you know that every company, they are employing some persons, and their responsibility towards the other authority that they will have to pay it. So, for that purpose, they must employ their funds profitably so far as earn sufficient income out of which to pay interest to the depositors, salaries of their staff, and to meet various other establishment expenses and distribute dividends to the shareholders. As far as concerned, the nationalized banks, they are responsible towards the government. Again, I am telling you, that is why that, as I have told you, the banker is not a charity. The banker, particularly when we are talking about the commercial bank, or we can say that the nationalized bank is also not exempt from it. They are also doing the same kind of business, and when they are engaging themselves, their purpose is to earn profits. How they will earn profit? If they will not invest in a proper manner, if they will not lend the persons who can return, he can give return or repay in terms of the interest. If it is not there, then we cannot imagine or we cannot think the bank can earn any kind of, you can say, or generate fund, or he can make a profit. So, for that purpose, as a profit earning institutions, it has to ensure that the persons to whom he is going to give the loan or providing the loan or advances, the persons must have a capacity to return in that principal as well as the interest. Otherwise, the bankers cannot earn profit, because without earning the profits, because to run that institutions, to run that business, the bankers is also employing the persons to carry out that business. He has to manage all the affairs. How it can be managed? Unless and until he will earn the profit. So, that is why there will have to be sufficient, you can say, the prospectus to earn the profit, because he has to meet out all the means through that sufficient income through which he can meet out the other, you can say, the interest of the depositors, because that is the primary duty towards him, and as far as concerned, because he employs some of the persons, it is duty to pay the salary of their staff, as well as the other kind of, you can say, the various requirement which requires to the establishment expenses, that has to be, and not only that, they will have to pay the dividends to the shareholders. So, all the things, all these responsibility are borne out by the bankers, and that can be met out only when the bankers have the sufficient means to earn profit. Now, the fourth one is, that is the purpose of the loan, that is very important. As you know, when the bank is giving the loan or advances to anyone, the first and foremost thing he is asking the people that what is the purpose of it. So, the purpose means to meet out that the persons who is asking for loan or who is willing to take loan from the banks, where he will invest that money or what is the purpose, that has to be ensured. And if we found that the purpose is, that is where the person is going to invest that money, that is not very, you can say, the worth. So in that circumstances, you find that the persons cannot return that money because the where he is going to invest that money, it is not profitable. So it is one of the sound, you can say, the principles before granting the loan. The banker has to ensure from the persons who is willing to take loans or advances from the bank, that he must know that what is the purpose, why the person is willing, why the person requires money, and where he is going to invest. And as I have told you, that it is not the banker's choices available when the bankers ensure that his money is safe, and the person who is willing to invest that money, that is his, you can say that the purpose is very fruitful, then only the bank can grant. Otherwise, the bank has a right that he can refuse to grant any kind of the loans or advances. Now, the fifth one is that is very important. In our day-to-day life, we are doing the same thing, because if you are investing your money, if you have some sort of money, then naturally you are not investing in a particular any place. Why? That's very important things, that the banks is also doing the same thing. The bank is not going to invest the money in a particular industry, because there may be, if that particular industry will lead towards the crisis, then the bank will face the problem. So that's why it is one of the very, you can say, the best principles, and it is not only for the bankers, every people are doing that, and every people must follow that principle. Why? Because if you will keep every money in a particular scheme, and you will find that a scheme, suppose if by any regions, if that ruin, or you can say that leads towards the loss, then you are also going to lose your money. So that's why the bankers is also taking that kind of care. And if the from one particular, you can say, the industry, if the people are pursuing for the loans and advances, bank will not grant, bank will not invest entire his money to a particular industry. So the principles of diversification risk, that you will have to divide your risk, you will have to spread, that you minimize, to minimize your risk, you invest in the various kind of, you can say, the industry, so that if one industry will be a loss, that the other industry will get the profit. In that way you will make balance. So that is very important, and the banks is applying that principles, that is the diversification of rules. Diversification of risk means the banker is investing its money not in a particular industry, but he is keeping or investing its money in the various kinds of, you can say, the industry, so that if one industry will run into loss, the other industry will reach in the, you can say that, or help to earn the more profit. So in between the loss and profit, they will make balance, and that's why that it's one of the very important principles such far as concerned, lending the money to the any persons, not invest in a particular industry or in a particular business. The money can be invested in the various. So this is also a cardinal principles of sound lending. A prudent banker always tries to select the borrowers very carefully and takes tangible assets as securities to safeguarding interest. So tangible assets are no doubt valuable, and the banker feels safe while granting advances on the security of such assets. Yet some risk is always involved therein. An industry or trade may face depressionary conditions, and price of goods and commodities may sharply fall. So natural calamities like floods and earthquakes, the political disturbances in certain parts of the country may ruin even a prosperous business. So again, I would like to mention here that as I have told you, the diversification of risk means the bankers will, whenever it is the loan, or you can say the persons who is willing to take advance or the loans from the bankers will check that in which industry or the persons belong to the which industry, and as I have told you that he will not invest all the money in a particular industry. And that is very, you can say that we have the famous maxim, and the maxim I would like to read out before you: do not keep all eggs in one basket. Suppose if you are putting all the eggs which you have in a particular basket, then if the basket, if you fall down, that what happen? You are going to lose all the eggs. So that's why it's suggested that you don't put the money in a particular industry. What you will do, that you put in the different parts in the different industry, and when we are doing that, suppose as I have told you that you can say the iron industry, if it is going in a loss for some reason, whatever may be, that might be the natural calamity. Suppose if you are investing all the money in agriculture sector and the natural calamity like the floods etc. took place. So what happened, that your money, the people, they will not in a position to return it because there is a natural calamity. That means you are safe. Why? Because you have invested in the various, and it is not very natural, we can say, that every industry will ruin at a time, or they will face the same kind of, you can say, the problem. So it is talking about that it's the one of the very cardinal, you can say, the principles as far as concerned, the whenever the bankers is investing its money or lending its money, the banker has to take care of that. He must diversification of risk is very important. I am coming to the next, that is the loans, or you can say the advances in the style of credit the bank apply. The bank, they are applying the four kind of, you can say, the credit systems, and particularly when we are talking about the commercial banks finance working capital requirements of their customers, the main style of credit or systems of financing prevalent in our country are, they are the four, you can say, that through which one is the cash credit system, the second one is overdrafts, the third one is loan system, and the fourth one is purchasing and discounting of bills. So as I have told you, it's a style of credit which is applying by the banking sector, particularly in our country, and these are basically the four: the one, the cash credit system, the second, the overdrafts, the third one is loan system, and the fourth one is the purchasing and discounting of bills. We will discuss in a very brief all these four. The first one, when we are talking about the cash credit system, so dear students, let me tell you, the cash credit system is the main methods of lending by banks in India and accounts for about 70% of total bank credit. Under the system, the banker specifies a limit called the cash credit limit for each customer, up to which the customer is permitted to borrow against the security of tangible assets or guarantees. A customer withdraws from his cash credit account as and when he needs the funds, and the deposits any amount of money which he finds surplus with him on any day. The cash credit is thus an active and running account to which deposits and withdrawals may be effected frequently. So dear students, that mostly when we are talking about that, this is the through which the bank is extending its loans and advances to its customers, that is cash credit system. When we are talking about the cash credit system, as I have told you, about 70% of the total the advances or loans that is granted by the banker through this system. And the beauty of this system is the customers have the liberty, the customers get the privileges. Whenever he wishes that he can withdraw the money from his the cash credit account, and as well as when he wishes to return that money, his liberty is available in the hand of the customers that he can return that money. So that beauty is that, as I have told you, the customers withdraw from the cash credit amount as and when he needs the funds, and deposits any amount of money which he finds surplus with him on any day. So it gives you can say the choice. The choice is available to the customers in what respect? In both the respect. As far as concerned the withdrawal, whenever he needs that there is the requirement, he will take the withdraw from the case credit limits whatever we fixed by the banker, and the banker will fix according to the status of the customers, according to the you can say the to what extent that the liability can be discharged by the customers. It depends on his business, and you can say that the other kind of you can say the securities and guarantees which has been given at the time of granting the such kind of the facilities by the banker to its customer. So, in this way that's one beautiful things which I have already mentioned before you, that the bankers got the liberty whenever he feels that there is the requirement of funds, he can withdraw from that account, and as soon as when he find himself that there are some sort of you can say the surplus amount which is available in his hand, the customers can deposit that. The next one is the very important things. In a very brief I would like to mention here that the advantage of cash credit system. If you will see that there is a flexibility which I have already mentioned before you, that the flexibility is that the borrowers need not keep their surplus funds idle with themselves. They can recycle the funds quite efficiently and can minimize interest charges by depositing all cash accruals in the bank account and thus keeping the drawals at the minimum level. The system thus ensures lesser cost of funds to the borrowers and better turnover of funds for the banks. As I have told you that there is no need to continue the things which you have borrowed from the banks. Whenever you got or you generate some sort of you can say the surplus money and which is available in your hand, you can deposit that, and the bank cannot stop you for depositing that. As soon as you are depositing that, that means your principal amounts will go lesser and you will have to pay less interest. The second, that the operative convenience, as I have already mentioned before you, the banks have to maintain one account for all the transactions of a customers. The repetitive documentation is avoided. So, there is only one account. With that account the bankers can handle all the transactions of the customers, and there is no requirement to again and again to meet out or you can say to fulfill the repetition of documentation. So, the repetition of documentations are avoided very easily. But at the same time we know that if there is an advantage, so naturally there are some sort of the advantage disadvantage also. So, the weaknesses of the credit system is, if you will see the fixations of credit limits, the problem is that the case credit limits are prescribed once in a year. Hence, it gives rise to the practice of fixing large limits than the required for the part of the year. So, the borrowers misutilize or unutilized gap in time of credit restraint. That the problem, the one is we can say weaknesses of this system, the cash credit system are that the interest rate will be fixed once in a year. And the second is the bank's inability to verify the end user funds, because as I have told you that only that the information which is available with the customer's account, with that the bank can understand. So, under this system the stress is on security aspects. Hence, there is no conspicuous efforts on the part of the banks to verify the end user funds. Funds are diverted without bankers' knowledge to unapproved purpose. Now, the money which has been granted, as I have told you that one of the things which you have discussed, that what are the very you can say the principles, and under these principles we have seen that the purpose, when the bankers is granting a loan to any persons, then he will ensure that for what purpose he is taking. But here that the account and the money has already been allocated to the customer's account, and there is no any kind of the check and balance between the banker and customer, though sometime it happens the banker do not in a position to you can say that whether the money which he has given for the purpose, whether that the customers or you can say the persons who borrowed the money from the bank, he is investing in that purpose, or he is going to invest that money in the other purposes which is not approved by the bank. That cannot be checked out by the banker, and that is the demerits of this system. The second, the style of you can say granting a credit, that is the overdrafts. Dear students, we have seen that the banker is only the institutions who is allowing its customers to open an account. as I have told you that the recurring can be that account can be opened by any financial institutions, the bank is also doing that. But as my question, when we are talking about the savings bank account, and that is the current bank accounts that can be opened by the bank only. So, the overdraft facility is normally available to the customers, those who have the current account with the banker. So, when a current account holder is permitted by the banker to draw more than what stands in his credit, such an advance is called an overdraft. The banker may take some collateral security or may grant such advance on the personal security of the borrower. The customer is permitted to withdraw the amount as and when he needs it and to repay it by means of deposit in his account as and when it is feasible for limit. The interest is charged on the exact amount overdrawn by the customers and for the period of its actual utilization. So, that is one kind of, you can say, liberty, and the very the well accepted forms of, or you can say a style of granting a loan and advances by the banking, that is the overdrawn. As I have told you, this overdrawn facilities is available with whom? The persons who having a current account in a bank. Normally, the current account at the time of opening, that with the status of, or you can say that the banker's understanding that the persons can have a capacity to return that much money. So, he will enter into an arrangement which we are calling it, and to that limit the bankers is granting the loan and advances as far as concerned in terms of the overdraft, and the customers is entitled to overdraw that money up to that extent, and the interest will be charged on whatever the amount he has overdrawn from the bank, on the basis whatever the interest rate is charged, that is already in the current existence rate of overdrawn facilities, and the same time that can be returned at the convenience of the customers at their end, but for to what extent that the overdrawn money is there, he has to pay the interest over it. Now, the third very important things that as far as concerned the styles of granting a loan and advances, that is the loan system. Under the loan system, credit is given for a definite purpose and for a predetermined period. Again, I am repeating it. Under the loan system, there it says the under the loan system, credit is given for a definite purpose and for a definite predetermined period. Normally, the loans are repayable in installments. Funds are required for single non-repetitive transactions and are withdrawn only once. If the borrower needs funds again or wants to renew of an existing loan, a fresh request is made to the bank. Thus, a borrower is required to negotiate every time he is taking a new loan or renewing an existing loan. Banker is at liberty to grant or refuse such a request depending upon his own case, resources and the credit policy of the central bank. As you know that every kind of, you can say, the rules and regulations from time to time, it is issued by the Reserve Bank of India. As you have seen that the Reserve Bank of India is entitled to issue any kind of, you can say, that the directions towards the banker under the Banking Regulations Act 1949 as far as concerned 35A and 36. So, by keeping that view that the Reserve Bank of India to regulate the interest rate, he is also under the regulations or rules, he is prescribing that what would be the maximum the interest can be charged. So, under this system, what happened that which is different from the credit card system which we have discussed. In the credit card systems where there is a liberties available to the you can say the persons who is borrowing money from the banker, he has a liberty to withdraw the money whenever he needs, and as for his you can say availability of funds in his hand, the liberty is there also that he can deposit that. But as far as concerned that when we are talking about the loan system, the very important thing is that it is given for a definite purpose and for a predetermined period, that if it is for example that any loan if the person is taking for a specific purpose. So, he has to mention at the time that what would be the loan amount. For example, that is the 6 lakh rupees, that is the predetermined period. Predetermined period here means that you will have to return that 6 lakh rupees within 5 years, 6 years, whatever may be, it depends on the party, they are entered into an agreement. So, the amounts as well as the purpose as well as the period is also predetermined, and if suppose the later on, if the customer means the persons who borrowed money from the banker, if he wishes to take more money from the banker, at that time again he has to negotiate, or you can say he has to request the bank again, which is not required under the cash credit system. Now, when we are talking about the advantage of the loan system, there are the 3 very important things which is important to discuss here, that is the financial discipline on the borrower. The second one is the periodic review of loan account and the profitability. The first thing that as the time of repayment of the loan or its installments is fixed in advance, this system ensures a greater degree of the self discipline on the borrower as compared to the cash credit system. And the cash credit system, as I have told you, it gives you the choice, and we know that even sometimes we do not find any kinds of the acute crisis, but if you know that if the choice is available, then the persons will withdraw money. It is human nature. But as far as concerned, under this system that you are not entitled to withdraw. So, it is a benefit that if it will give you the self discipline as far as concerned the borrowing money from the banker. The second one is the periodic review of loan account, that as we have seen that if you wish to renew or if you need more money, then again you will have to go before the bank, and the banker has a entire, you can say, the discretion lies to the banker. He may accept, he may not accept. It is not necessary that he will allow you. So, whenever any loan is granted, its renewal is sanctioned, the banker gets an opportunity of automatically reviewing the loan account. Unsatisfactory loan accounts may be discontinued at the discretion of the bank. As I have told you, as far as the cash credit system, we or do not know that the purpose which you have means for which purpose the loan was granted, and the later on it cannot be scrutinized by the bank, or it cannot be the bankers cannot have any kind of mechanism to know about that whether the money which has been granted, that is utilized by the you can say the persons that for the same purpose. It is unknown by the bank, but as far as concerned here, the bank can review it, and at the some time you will find that if you find that the customers is not fulfilling, or you can say the banker is not satisfied with the returning the money or the activities of the persons who borrowed money from the banker, he can discontinue it. The profitability, the system is comparatively simple. Interest accrues to the bank of entire amount lent to a customers. As you have seen the cash credit system, the whatever the money you have taken, or in the overdrawn we have seen that whatever money you have taken you have to give. But as far as concerned this that it is predetermined. So, at the beginning the money at the interest rate is determined for the period of, if there is no flexibility is accepted in the terms and conditions, then once it is fixed for the 9%, then you will have to pay for the entire period, that is I have told you whatever maybe the 5 years, 6 years what you have fixed, that you will have to pay the 6% interest. The disadvantage the loan system is of this, that is the inflexibility. It is not flexible like the cash credit system. So, every time a loan is required, it is to be negotiated with the banker. To avoid it, borrowers may borrow in excess of their exact requirements to provide for the contingency. So, what the customers will do, when he wish to take loan from the bank, then he will, suppose he requires only the 5 lakhs rupees, but he knows that maybe there is a chances that after the 2 years I need more money. So, what he will do, that unnecessarily he will burden for himself, that because he know that for the renewing it is again that you will have to negotiate with the banker, and there is unfortunate you can say the things also, that you cannot expect that what would be the after 2 years, what would be the means the interest rate over that loan. So, maybe you will take unnecessary money, or you are overburdening, because due to this kind of, because it is not inflexible, it is not a flexibility like the cash credit system. So, due to the inflexibility that the persons who is willing to take loan or advances from the bank, he might have overburden by taking excess money from the banker. The banks have no control over the use of funds borrowed by the customer. However, banks insist on hypothecation of the asset vehicle purchased with loan account amount. Though the loan are for fixed period, but in practice they roll over, that is they are renewed. And the last kind of, you can say, the disadvantage you can take, the loan documentations is more comprehensive as compared to the cash credit system. As cash credit system, we have seen you have to enter into the once whatever may be the terms and conditions. There is no requirement of the again and again, but as far as concerned that due to that renewal process is available here, that you will have to again undergone through the again and again that the negotiation with the customers, and it's a time taking process. Now, the types of loans which is granted by the bankers sector. The banks grant loans for the different periods, short, medium and long, and the different purposes. Broadly, the loans granted by the banks are classified as follows. They are the 5 category of generally which you have heard. Just I would like to again to put before you. They are the one we are calling the short term loans, the term loans, bridge loans, composite loans, and the very popularly which is available with the banker for its customers, that is the personal loans. So, this whatever the things which you are talking, it is for the purpose of what? For the different purposes. For the different purposes, the interest rate is also different, because it will be determined on the basis of the interest, the needs, the requirements, and on the basis of that these are given in the 4 category: the short term loans, term loans, bridge loans, composite loans and personal loans. Let us see one by one. As far as concerned, when we are talking about the short term loans are granted to meet the working capital needs of the borrowers. Again I am repeating it. It says the short term loans are granted to meet the working capital needs of the borrowers. These loans are granted against the security of tangible assets, mainly the movable assets like goods and commodities, shares, debentures. You will have to remember, because these things again we will discuss in the next lecture, as security when the bankers will accept all these things. So, since April 1995, the Reserve Bank of India had made it mandatory for the banks to grant portions of bank credit to big customers in the form of loans for various maturities. But now this ceases to be mandatory. The Reserve Bank has also permitted the banks to roll over such loans, that is to extend the loan for another period at the expiry of the tenure of the first loan. So, that the short term period loan, short term loans that is granted for the period of, you can say, for the meet out the working capital needs of the borrowers, and these loans are granted against the security of tangible assets, mainly the movable assets like the goods and commodities, shares and debentures. So, as I have told you that since 1995, the Reserve Bank of India had made it mandatory for the banks to grant portions of bank credit to big customers in the form of loans for various maturity. So, it is also granted for that purpose, but as I have told you, but that now this ceased to be mandatory. Earlier it was mandatory, but now it is not mandatory for the any banking that to grant the loans on the basis of the various maturities. But this meet out, you can say, by accepting some sort of, you can securities, it can be available for the any you can say the borrowers for meet out his working capital needs. The term loans, the name itself indicates that term means it is for a specific purpose. So, the bank often refinance on term loans sanctioned by them from the refinancing institutions that is associated with the others, and with the help of that it is granted, like the Small Industries Development Bank of India, the National Housing Bank and NABARD. The medium and long term loans are usually called term loans. These loans are granted for more than a year and are meant for the purposes of capital assets for the establishment of new units and for expansion or diversifications of an existing unit. Banks usually grant such loans together with a specialized financial institution. Such loans constitute a part of the project finance which industrial enterprises are required to raise from the different sources. These loans are usually secured by the tangible assets like land, building, plant and machinery, etc. Now, see, term loans is, as I have told you, that it is granted by the banker with the association of the other financial institutions, the financial institutions which are made or established for a specific purpose. For example, for the development or you can say establishment of the Small Industries Development Bank of India, which helps to establish for, or you can say the expansion or establishment of the various kind of the industries, the banker in association with the Small Industries Development Bank of India is doing that work, is granting that. Similarly, for the housing developments and the other cooperative housing developments, the bank is associated with the financial institutions bank, that is the National Housing Bank, and as far as concerned the agriculture project, that is associated with the NABARD. So, the medium and long term loans are usually called that is the term loans. As I have told you, these loans are granted for more than a year and are meant for the purchase of capital assets, for the establishment of new units and for expansion or diversification of an existing units. So, as I have told you, the bank usually grants such loans together with specialized financial institutions. Such loans constitute as a part of the project finance which industrial enterprises are required to raise their different sources. Now, another you can say the kinds of the loans which we are calling the bridge loans. The bridge means in between the two things we need from move from one part to another, then we will need the bridge. So, similarly, that to correlate the two things, that the bridge loans are granted by the banks also. So, the bridge loans are essentially short term loans which are granted to industrial undertakings to meet their urgent and essential needs during the period when formalities for availing of the term loans sanctioned by financial institutions are being fulfilled or necessary steps are being taken to raise the funds from the capital market. These loans are granted by the banks or by the financial institutions themselves and are automatically repaid out of amount of the term loan or the funds raised in the capital market. Now, let me tell you why it is called the bridge loans. For example, the persons who has applied the loan under the terms loans, and the under the terms loans only applying that might be to complete the formalities, it requires some sort of time, and within that period, suppose you wish to have some sort of, you can say, the money is required at that time. So, how that the gap can be met out? So, for that purpose, of the persons who had already applied or the persons applied for the loan under the terms loans, but due to some sort of, you can say, the incomplete of the in completion of, you can say, the formalities, that it is the time taking process are involved there. So, during that period, during that you can say the shorter period, if they require some sort of the loans and advances, whether that is available, and it's the answer is that yes, there is a loans which is available in the name of the bridge loans, and as soon as the bridge loans, that is for the shorter period granted by the banker itself, and when it is granted, as soon as the term loans were sanctioned, from the term loan that amount can be deposited. Then the fourth one is, that is composite loans. When a loan is granted both for buying capital assets and for working capital purposes, it is called a composite loan. Such loans are usually granted to a small borrowers such as artisans, the farmers, small industries, etc. So, the composite loan is granted, it is not granted for the big industrialists and the others. The big industrialists, the others, they will take their loan in terms of, you can say, the term loans. But hedge fund concerned that the small scale, or you can say the other kind of the needy, those who wish to carry their business, like this artisans, the farmers, the small industries, they have provisions that they can avail the loans from the banks, and when they are availing the loans from the banks, these are termed as a composite loans. The composite loans means when a loan is granted both for buying capitals, assets, and for working capital purposes, it is called the composite loans. For example, suppose that the small scale industries, for example, that the persons, if he wish to establish the lathe machine, so he needs money for what? To purchase the lathe machine. So, this is given for what? To buying the capital assets, buying the capital asset. And on the other hand, when we are talking about the farmers, suppose they need some sort of, you can say, the money to buy the tractor, because with the help of tractor he will use that for the purpose of the agriculture purposes, or if suppose they wish to buy any other you can say the machines which will use for the purpose of the agricultures, like the pumps and the other things. So, that can be permitted, and the bankers may allow, and when the bankers is allowing such kind of, you can say, the loans, that will term as the composite loans. Then the fifth one is, that is the personal loans. The personal loans, when we are talking about, it is the most of the time you will find that is a very popular word. The people, whenever he feels that there is a need, then he can go before the bank and he can ask for the personal loan. So, personal loan, as the name itself indicates, it is given for the personal reason. So, the commercial banks are now increasingly granting retail loans to the individuals for various purposes, like consumer durables. As I have told you, that if you wish to buy some sort of, you can say, for your own domestic purposes, like if you any luxurious, or you can say the comfortable things, that can be the consumer durables, the housing, credit card outstanding, auto loans, other personal loans, that maybe that the name itself indicates that the personal region. Now, let me again explain these things in a very brief, so that it can be understood to all of you. That is, I have discussed with you, that is types of loans. As far as the types of loans, it is the, in what manner the banker is granting a loan to its customers. It is nothing, all are loans. But as far as concerned, when he is granting, he will ensure by applying the cardinal principles which we have already discussed, that the cardinal start from what? It start from that the security, it start from the safety, it start from profitability, it starts from diversification of risk. So, all the things taken by applying all the things, then we have seen that okay, the banker is granting, what the banker is granting? The banker is granting the loans in a different system, the different style. And what are the style? We have discussed the four style, that is the credit card system, the overdraft system, then the loan system, and the purchasing and discounting. All these systems, when we have discussed, then we have discussed the merits and demerits of all the things, and then we have discussed that the types of loans. The types of loans, as I have told you, that it is granted on the basis of the needs of the people, on the basis of the purpose which is determined, and that at the time of granting the such things, he will, what he will do, that he will ensure. And how he will ensure? He will applying the principles of sound lending. The banker will apply that, and when he will satisfy himself, then he will grant the loan in the following terms. As I have told you, the short term loans, the term loans, the bridge loans, the composite loans, and the personal loans. Each and every loan has its own purpose, and it is ensure that the persons where he is going to invest, how way he is going to invest that, and the bankers will ensure by going through their purposes whether that the purpose will meet out its needs or not. That what is the needs? Needs that whether the persons is in a position to, after 5 years, whether he will find in a position to return his money or not, that has to be ensured. As far as concerned the short term loans, which I have told you that it is granted for a specific purpose, and the purpose is that the working capitals of the need of the borrowers, that has to be met out. Then, as I have told you, that the terms loans, that is very important, as we have discussed. Most of the time we can say that these kind of the loans is provided by the bankers to the big industrialist, and for the purpose is that for the establishment of that, and he is not granting alone, he is granting that loan in association with the specialized agencies which were established for the purpose of that, like as I have cited with the example, suppose for the industrialists that we have a small industries development bank of India. If for the promotion of the house and the other housing development, then for that purpose we have a national housing bank, and as far as concerned that for the development of the agriculture sector we have a NABARD. So, that when this loan is granted, this kind of loan granted for a specific project, and that in association with these special financial agencies. Then I have discussed the bridge loan. The persons who has applied for the terms loan to obtain or get the terms loans, and if still it is not sanctioned, and in the meantime if he needs some sort of the money, then there is a provisions for granting the another kind of loan for the shorter period, and that amount can be returned through what? The amounts which will be available after sanctioning the terms loans. On the basis of that, the some sort of money can be borrowed from the bank by security. What is the security? That the amount which is going to be sanctioned in the terms of the term loan. So, that is very important, and when it is granted at the time, it will be taken back. There is a bridge. Then I have told you that the composite loans, that is granted for the very, you can say, the small scale industries, artisans or farmers or small industries. And then I have told you the last one, that is the personal loans. As we know, the personal loans is for the personal region, as I have told you that it might be the consumer durables, housing or credit card outstanding, auto loans or other personal loans. Now, the classification of loans and advances, it has been classified in the two, as I have told you that again we will discuss when we will discuss about the securities. That is, the loans are that we can categorize the two, the secured and unsecured advances, the secured and unsecured advances. I would like to read out one provisions. According to section 5A, clause A of the Banking Regulations Act 1949, it is very clearly mentioned. A secured loans or advances means a loan or advance made on the security of assets, the market value of which is not at any time less than the amount of such loan or advance. An unsecured loan or advance means a loan or advance not so secured. So, we can say that it is the antithesis of it. The secured loans means the for which we have taken that the security, and the unsecured means where we have not taken the unsecured. So, thus we can distinguish the features of the secured loan and advances are as follows. The loan must be made on the security of tangible assets or goods like the commodities, then we are calling that as secured one, and that the amount that must not be at any time the loan amount which we have granted, that value is not less than that. So, we are calling this secured, and without taking all kind of the tangible, you can say the security, then we can say it is the unsecured. With this, I would like to thank you very much for listening and patiently hearing these particular things, and the certain things we will discuss in the next lecture when we will discuss about the various kinds of the securities which is granted by or taking by the banking sector from its customers. Thank you very much.